In today's video, we're going to look at how us at Prosperity Algo Solutions use the COT report to track institutional positioning. So, as you may have seen in the past week, gold has been rallying absolutely extraordinarily. And there's also been these massive red days. And along with this, there's been obviously tons of speculation regarding like what's going on with gold, what's going on with the markets more broadly. Like what are people doing? Are people getting rug pull? Who's selling? Who's buying? Did somebody try and induce retail to get in? And there's always a lot of kind of speculation and trying to guess what institutional players are doing. And in this light, I find that one of the best things to do is to look at government filings and look at COT reports to actually try and ascertain and separate the noise from reality. So right now, for instance, in this gold rally, the narrative is that institutional funds pretty much exited to retail. And when a lot of that euphoria started happening, many retail traders were left holding the bag. Or more so than even just retail traders, even like retail investors and private individuals buying gold funds would have been hit here. And the main thing is, like, can we actually see that in the data? What have institutional funds actually been doing? And the COT report does tell us this. And for instance here, this is the filing which came out this Friday. So it's the 31st of January 2026 right now. And this would have been published on the 30th, but it would be looking at data from the 27th. So this would have been like the COT reports are always a snapshot of a Tuesday futures position, and they're released on Friday. And if you guys don't know, COT reports are essentially a government filing by the CFTC, which is a U.S. government agency. And if we go here quickly, we can see that the CFTC is like the SEC, but for futures and for any sort of commodity-based contract. So they actually track all futures positioning by large funds, by large speculators, as well as by retail traders. So instead of us trying to speculate, hey, looking at this chart, did retail get hosed? We can look at the actual filings to see what really happened. What's really interesting is if we look at this past week's report, for instance, we can see that if we look at gold and we look at the various participants, non-commercial being large funds, commercial being mines, and non-reportable being retail, what's the biggest thing that we can see? What's the number that really stands out here? It's this minus 43,000, right? So this shows us that large funds were heavily selling some of their long positions. Yes, they did also sell some shorts, but this was a major sell-off in some of their long positioning, right? And if we were to look at, for instance, COT historical data, we can see, for instance, last week's report and see that it was significantly different. Like this would have been from last week. We can now go to Commodity Exchange Incorporated, and we can see that gold last week, they started to sell, but not much, right? It was just like fairly modest. But then the week before that, we can now go back here and look at the 13th, and we can look at Commodity Exchange Incorporated, and we can see that this was still a time where they were massively increasing their long positions in gold. So what does this show us? Like on the way up to the rally, the big funds were loading up on gold. They were just buying gold, right? And now that it started to, right before the market started to turn, this would have been here on Tuesday, or Tuesday would have been right here. So like right here before the turn, they started liquidating. So what does that show us? That like institutional traders largely know what they're doing because they started buying heavily around here and they started selling roughly around here. So maybe they'll get back in, who knows, I don't have a crystal ball. But it's a good way to show that if you really want to kind of cut through the noise and look at the actual reality and the objective reality, the COT reports show us what these people are doing. And this particular week, they have been selling gold heavily. At the same time, if we look at, okay, if they've been selling gold, where exactly have they been putting that money instead? And, let me just Google CFTC, Commitment of Traders, there we go. We can look at some other major products here, such as NASDAQ. We can look up the NASDAQ. We can see that this week, for instance, they've been going heavily long on the NASDAQ. And why is that? It's because theoretically, or just knowingly, it's earnings season, right? So like with the tech stocks, many tech companies reporting, many funds likely wanted to cut their gold exposure and instead increase their NASDAQ exposure. It isn't necessarily the exact same fund, but as if you look at the market overall, that's what's been happening. So it's a really interesting kind of snapshot, which I wanted to share with you guys, that if you want to be able to kind of know when you should be in the market and should be out of the market, if you just objectively look at what the big funds are doing, it can really inform you heavily in terms of what's going on. Whereas if you try and say like, oh, I think gold is going to keep going up, or I think it's going to be going down, it's really, really hard to know, because like fundamentally none of us know for sure. And instead, kind of looking at the wisdom of the crowds can be a pretty smart approach. So guys, next time you're trying to figure out what institutional traders are doing, stop guessing and just read the COT reports, because it's really a great window of opportunity into seeing what exactly they're doing. So guys, hope you enjoyed the video. See you in the next one.